A lot of people ask me, what's the difference between the dividends and you, Mark, you talk about this thing growing guaranteed. Well, what's the difference between dividends and what's known as the non-forfeiture guaranteed interest rate in my contract? The contractual guaranteed non-forfeiture interest rate is the rate used in the calculation of your cash value, the guaranteed cash value accumulation. It is not, I repeat, it's not the rate used in calculating dividends. So I want you to think of cupcakes with icing, okay? So the non-forfeiture interest rate is the cake. It's the guaranteed increase of your cash value every single year for the rest of your life. So hear that very clearly. That is the cake on this metaphor. The dividends are the icing on the cake. Dividends are not guaranteed, but are an extra helping. They're an extra treat on top of the guaranteed cash increase. And just as a side note, the companies I work with have consecutively put icing on their cupcakes for 100 years or longer without fail. So that is quite a track record of icing. Next question. What is the most important thing about dividends? Okay, here's the fun fact. The most important thing about a dividend is what's underneath. It's the guarantees. Again, some companies misunderstand this, or they view dividends as some sort of a marketing ploy rather than what they should be, which is a reward to the policyholder for sticking with them for the long term. So here's an example. Let's say you're faced with two insurance companies and you're trying to pick which one is better. Company A has a 1% dividend and Company B has a 4% dividend. Which one sounds better to you right now, just on its face? Well, clearly Company B with its 4% dividend sounds like it's doing much better, right? Right? Sounds to me like it. But remember what I said about cake and icing. There's both guarantees and dividends baked into every dividend-paying whole life insurance cake. Now, what if in both of these companies' circumstances the total was 5%? Would that change your picture of which one was better? What would you rather have? A company where a dividend of 1% and a higher guarantee of, let's say, 4%, or Company B, which had a 4% dividend and only a 1% guarantee? Both companies, total cake and icing was 5%, but which company now seems more dependable to you? That's right, Company A sounds better because I'd rather have a 4% guarantee and a 1% non-guaranteed dividend. Remember, dividends are not guaranteed, but the guaranteed increase of the cash value, that non-forfeiture rate, is. And the dividend depends on the insurance company's performance, investment returns, expenses. All of those things can change. Whereas the guaranteed increase of your cash is baked right into your cake. It's right into the contract. It cannot be changed. The guarantees in your contract are what ensure that your policy will perform even if dividends falter, which offers you much more predictability for long-term planning. Now, guys, here's an industry secret. Insurance companies don't want you to know about this. It's true that contractually speaking, an insurance company cannot change the guaranteed increase of the cash value once your policy is issued. Okay, so once you've bought your policy, it's issued and set up and you're paying premiums, that guarantee is locked in for life. However, many insurance companies out there make new decisions all the time on possibly lowering their guaranteed rate on new policies so as to inflate their dividend and make them look more sexy, more interesting, more profitable. So they can sell this new version of the product out there with a lower guarantee and a higher dividend. Think of it like shrinkflation for your whole life insurance. You remember shrinkflation, right? Where they would shrink the size of the potato chip bag. This happens with whole life insurance by lowering the guarantees on new policies. Again, they can't change one once it's locked in. But on a new policy, they can decide to sell that new whole life policy with a lower guarantee, higher dividends. Again, shrink the cake, increase the icing, which may or may not always be there. Now, I often see insurance companies flaunting these big, juicy icing related dividends, but hiding the fact that they've lowered those guarantees. Again, the shrinkflation is hard at work here with contracts going forward. And I also see consumers, the buying public, getting confused about dividend rates and guarantees, which leads me to my next question, which is what is the most frustrating thing about dividends? Now, there's nothing much frustrating about them. It's wonderful to receive them. But I guess you might say the most frustrating part of understanding dividends is that there is literally no uniform industry standard for calculating the dividend rate. So while subject to many of the same factors of market pressures and more, insurance companies will calculate and report dividend scales quite differently. Okay, so the dividend rate at company X is going to maybe be very different than the dividend rate at company Y. They might have different formulas for calculating their dividends. So is it really even a meaningful metric to compare two insurance companies off the dividend rate? No, it's really not. As a financial planner, I often caution people about the red herring of insurance companies that obscure whole life policies' true performance through dividend manipulation.